Hey, good afternoon. I actually brought a guitar. I hope we're gonna be okay if you don't mind us streaming that right now. Just kidding. Bad joke. So now we're gonna talk about some of that sweet, sweet venture capital money that's funding so many media startups right now. Last week, the CEO of Slack, Stuart Butterfield, told the New York Times, "This is the best time to raise money ever. It might be the best time for any kind of business in any industry to raise money for all of history, like since the time of the ancient Egyptians. It's certainly the best time for late-stage startups to raise money for venture capitalists since this dynamic has been around." It's a pretty bold statement, since like the time of the ancient Egyptians. So just to give you some context, last year, venture capital poured at least $683 million into digital media companies worldwide. That's more than twice of what it was in 2013, and that's according to Preqin, which tracks venture capital investments. And then for some more context here, that money's going to places like Medium, which is a platform that's raised $25 million, Refinery 29, which has raised $30 million, Vox, which has raised $110 million, and BuzzFeed, which has raised about $100 million. So now, in light of all that, we're going to talk to some of the people who are helping direct some of that money. We have Sim Blaustein, principal at Bertelsmann Digital Media Investments, Todd Breeden, vice president at StarVest Partners, and Eric Vreeland, who's an analyst at Bowery Capital. Thanks for joining us, guys. So let's start with that quote from Stuart Butterfield, the CEO of Slack. Do you agree with that assertion? Best time in the history of civilization?
I think, first of all, he's in a unique position. I think that we're trying to give advice for everyone in this room, and if they had founded the next Slack, they probably wouldn't be sitting here right now. They'd probably be working on the company and being worth $2.5 billion. So, and to kind of give background, because my information's I just joined. We don't do late stage investments, so we do early stage investments. So I think he kind of qualified that as saying for a late stage company, it's a really good time to raise money. So, if you get a valuation of $1 billion and they say they want to throw an extra $200 million your way at a super good valuation, I think that's a great idea. I think it's super risky for an earlier stage company that might not have found product market fit to do something like that, because you have really high expectations once you do that.
Sure.
Well, I mean, I agree that he's in a unique situation as a late-stage company. I mean, if you look at a generation prior, no one was raising private rounds at $1 billion valuation. That was an acceptable time to be a public company, and that's really where the public viewed the risk to be off the table. And so you had more casual public investors going into what they viewed to be kind of a sure thing and riding the upside growth. Nowadays, with the regulatory environment what it is, there's not really an incentive to go public early given the amount of private capital available, so that an Uber can stay private up into a $15, $20 billion valuation, because you don't need the public markets to get your market cap that high. So certainly as a late stage company, it's great. The vehicles are out there to raise the money. However, at the earlier stages, I would say it's almost more difficult, as difficult now as it's ever been, given not only the number of sources of good money, but also bad money out there, and raising lots of money from a bad VC or a bad entity is not going to be helpful for a lot of early stage companies. But also just the number of qualifying sources, the hurdles in which companies aren't raising Series A's without minimum viable products and without customers already in traction. And so while at the late stage it's certainly easy because there's lots of money piling in, I would argue the early stage money is still extremely difficult.
Yeah, I mean, just to build on that, first of all, what an awesome last name, Butterfield. I mean, I think if your last name is Butterfield, it should be easy to raise money. But I think just the fact that sort of these extrinsic factors, it's harder to become a public company. There's a lot of public money looking for growth that they can't find. They could have invested in these companies 5 or 10 years ago after the IPO. They can't, and so that money's still on the table and it's moving into the venture markets. But I think the flip side to that, and this is a little bit of the bull argument, as to why late stage and even some earlier stage. I mean, Series B, where do you want to define that? You're starting to see maybe not as easy to raise money, but certainly easier to raise lots of money, right? We're now at a time where a $10 million Series A is not abnormal. A $30 million on a 70 pre Series B is not unheard of. And it wasn't that long ago that wasn't the case. I think the bull case there is that the ability for either consumer or B2B companies to distribute and get to scale very, very quickly is unprecedented. Whether you look at the penetration of broadband throughout the world, the rise of mobile and people, ever more people being connected, the ability to go from you've never heard of them to hundreds of thousands of daily active users, which I think Slack has done within the course of a year, is unprecedented. And I think the infrastructure for building new companies very, very quickly is something that the market is trying to figure out how to appropriately value.
So let's get down to the matter at hand and talk about why you guys invest in media startups. So maybe give us a little bit about your philosophy or rationale, and then tell us about some of the companies, both the industries and the specific companies that you have invested in your companies.
Sure. So I have digital media in the name of our fund, and we do invest and are very bullish about a lot of areas of media companies. So just quick background, BDMI is the corporate venture fund for Bertelsmann, which is the largest media company in Europe. We're kind of like the David Hasselhoff of media companies. We're big in Germany. And people sort of remember us from the 90s in the US. So we very much believe in the future of media for some of the same reasons I was talking about before. I mean, just the disruption and ability to reach distribution scale very quickly. So examples of companies we backed, video is a very interesting sector for us. We're the largest television company in Europe, and so we've done companies like Style Hall and Drama Fever, which were both very successful exits for us last fall. On the sort of non-video side, we're investors in companies like from Mike Media and Hello Giggles, which are both earlier stage companies that are actually kind of going after the millennial demographic. And I think that from our perspective, we believe that the internet is now at a point in time where quality content and interesting and disruptive business models can be rewarded. I think you're seeing that with Vice and with BuzzFeed and with a number of other companies there. And we definitely think it's an exciting time to be a media startup.
So StarVest Partners, we're an enterprise software-focused fund doing B2B tech. So to the definition of investing in media startups, a Vice or a BuzzFeed wouldn't really fit within our philosophy. But if you look at sort of what the top media brands are in the country right now, I mean, Red Bull is at the top of a lot of people's lists, where the content that they're making around extreme sports, via people jumping out of space shuttles, and they're owning that brand and that messaging, and you're seeing a lot more enterprises that are focusing on their own content and being able to not only distribute widely to where their audience is, given whether it's on a device or a specific channel, but also making sure that content's relevant and engaging. So we have companies in our portfolio, one called Outrigger Media, which is helping tie brands' advertising content on YouTube as the pre-roll to the content that's behind it. So Carnival Cruises won't have their pre-roll ads running in front of ISIS videos, basically. Mm-hmm. So because they can't afford to have that brand tie in today's market.
Yeah, we're similar in that I wouldn't say we would invest in traditional media companies, but we'd invest in a lot of tools that are helping media companies adapt to kind of the new environments. So obviously there's been a shift to mobile. We've invested in a company called Carnival Mobile that helps these brands that are now developing mobile apps, helps them kind of re-engage with their audience and keep them engaged with their apps. All these brands need to know what their competitors are doing. So we've invested in a company called Track Maven that allows brands and media companies to keep tabs on what their competitors are doing. mParticle acts as kind of a data hub for all mobile apps. Their biggest customer is Spotify. They help them manage all of their mobile data through their devices. So even though we don't invest directly in media companies, we see a lot of opportunity in the media space and with investing in tools that can help them do their job better.
Got it. If I'm going to walk up to you after this session and hand you my business card and say, hey, I got a media startup. You guys want to invest in it? What should I know? Give me a tip.
Don't do that to me.
Yeah.
It's a tip, all right.
I mean, one of the problems I see or issues both with founder decks, but founders as they describe their business or how they're going to grow it is they try to describe the problem they're solving or the challenges in the market with really qualitative terms, saying, wow, this is an underserved market. There's a big problem here. There's a huge world of people who are interested in millennial food, or just something along a niche category that as a venture investor, we generally, or at least maybe it's just me, but we have surface level knowledge of lots of things, but in-depth knowledge of really very little. That just comes with the territory of evaluating over 1,000 companies a year. And so when someone comes to me to say, I have a media company that services a niche community that is growing and is clamoring for content, I have no idea to evaluate whether or not that's a big opportunity or not. And so really diving into some of the demographic data or being able to quantitatively describe what your constituent really looks like, then that starts to be able to get our attention and then have a good conversation beyond that, because qualitative terms just don't get eyeballs.
Got it. So if I am going to target millennials, that's going to be a little too broad, I take it?
Well, it's like within millennials, it's okay, millennials as a whole, what aspect of millennials? Millennials, is it millennials who travel? Okay, millennials who are getting ready to travel, how often do they travel a year? How valuable is that community? If the millennials are buying, if you know that a large group of millennials are all going to be in Florida this weekend for a festival, is that data?
Don't go.
Don't go, but is that data replicable in other places? Sort of what's unique about your audience and the information you're getting about it? And then that starts being able to really say, are you on to something that's a really interesting opportunity, or have you just sort of built a fun to play product that, that won't become the next BuzzFeed?
Yeah, I mean, I would say that the barriers to building a new media company have never been lower. And while that helps to scale quickly, it also means that there's more competition and sort of more of the same in a lot of different, especially obvious markets. And so for me, I think the first thing is the sort of why or why you. And I sort of ask both because I always want to know why people started a company. Sometimes it's a personal need, and sometimes that personal need is serving a niche market that doesn't make sort of sense for a venture-backable business. But I think every company that's interesting to me is solving something that is sort of deeply personal and interesting to the founder. And at the same time, I want to hear why is that company uniquely enabled to kind of become a big company, right? So there should be a special special sauce, special angle. So, maybe we're serving millennials, maybe we're going to be the most, relevant place to find travel information, or maybe we have a unique angle on creating video, which is something that is relatively hard to do compared to other forms of content. And so I think that there's, there has to be some form of differentiation that is both unique as well as scalable into a billion-dollar company.
What's a media trend that you're seeing that's particularly interesting, whether it's because the money is flowing that way or because you're feeling kind of prescient and thinking, wow, this could be a ripe area for investment?
I mean, I'll just throw out one because I feel like now every day I'm hearing something of about an esports company. And those are interesting to me, partly because I loved playing video games as a kid, although I'm still kind of adjusting to the idea of people watching folks play video games. I think as Adi from YouNow was just talking about, that is a thing. It's a big thing, actually. And so there's a lot of stuff happening, companies like Vulcan and Alpha Draft, which are sort of building the, FanDuel for esports or the X for esports. I think we're seeing a lot of those, and there's definitely a lot of money flowing into that space post Twitch exit.
Yeah, I think we talked about it a little bit earlier, but kind of every brand becoming a media company now, and they're not really built to be a media company. So any tools or companies that make it easier for them to publish content or to analyze the content that they've published or to attract new viewers, that's not what they were built to do. So anything that makes it easier for them is going to be, a good company.
Yeah, I think touching on sort of the relevance idea, as I was going before, you're seeing a lot more precise segmentation, both within media outlets where you have more and more niche communities that serve specific reader bases that then are allowing advertisers who are focused on the food industry to be able to target the 4 media publications that directly serve people who are foodies. And so you're seeing more segmentation tools alongside on the media front, but then also tools that are helping horizontal players such as Gawker Media or New York Times or these larger entities be able to segment within their own readership bases and identify, hey, this person has been touching on all of the articles within our horizontal platform that are related to food. I need to serve them the food advertisements that they'll then be more likely to convert on. And so segmentation to me seems like it's got a lot of runway to go.
What's a company that does that?
We have a company called Ceros that has just started to do that within their product suite. They're a tool for brand designers to create interactive web content. And with the new SDK they've developed, if you've tagged a user,
SDK.
it's a development engine. But if you've tagged a user who's coming into your homepage as someone who's more likely to convert on, say, a food product, it will optimize the homepage or the assets that you've created to cater to that individual versus someone who's been tagged as someone who's very interested in politics or someone who's into esports or other categories. So. And they're doing that without the need of coders, so it's the brand designers being able to do that themselves, which is really revolutionary.
Yeah. Let's talk about media revenue here for a couple minutes. As I cover the media industry, I'm sort of amazed that we have all of these disruptors like BuzzFeed and like Vox, you name it. And they have these really interesting approaches to the way that they present and report on content, and yet when it gets down to their business model, it's the same as the companies they're trying to disrupt. We'll just build an audience and sell some ads. I mean, is this something that when you're looking at a media company, what do you look for in terms of revenue? I mean, is it if they come to you and they say, we're going to sell advertising? Are you skeptical about that? Or do you want to see something more diversified like e-commerce, subscription revenue? We see a SaaS model. I mean, how does this work?
I mean, there's a lot of excitement around getting people to pay for stuff. There has been, I think, since the web was born, and there are very, very few examples of getting people to pay for stuff.
With the exception of Netflix.
Right.
I mean, what?
And I argue Netflix is basically just television by other means, and people have been trained to pay for TV for decades now. So telling them they should continue to pay for TV but pay less and get more isn't very hard. Whereas I think people have also been trained that if they go to an average website to get content, they're getting it for free in exchange for their attention to advertisers. And so, I mean, a lot of people have said that advertising is the sort of endemic or native business model to the web, with exceptions like dating, and there's a lot of paid dating. There's microtransactions and gaming and things like that. But by and large, when we think about media, whether it's video or articles, I think, there's probably, if you looked at the minutes spent of media consumption on the internet, I would be shocked if less than 90% of it was advertising supported, and more than 10% were paid. But I'll disagree a little bit to your point about the disruptors, and less. I don't know Vox as well, but I give BuzzFeed some credit because the traditional business model is build an audience and then sell those eyeballs to advertisers, and BuzzFeed undoubtedly does that. But they've done, I think, two things that are also very, very interesting. Number one, they've convinced advertisers that they will still pay for those eyeballs to be on other sites. This notion that they can distribute both their own and sponsored content on third-party sites, notably Facebook, where so much consumption happens, is new. It used to be that if you wanted to make money from an eyeball, they had to hit your site. They had to be on your own property. And I think BuzzFeed has done an amazing job of convincing the advertising community to buy their quote-unquote distribution on third parties, which has actually opened the door for a ton of other companies. The other thing they've done is I think they have legitimately built a technology-enabled process to sort of get social distribution, which gives them the ability to charge a premium in the market. And so I would put them in a little bit of a different category than the quote-unquote like eyeball businesses that a lot of other audience-based businesses are in.
Advertisers are still paying the bills.
Absolutely.
Yeah.
I try and I do, even within media startups, I do a lot of mentorship with early stage companies that don't fit our investment thesis. So I do touch on some of this, and where I get caught up is if a startup or a media company is going and is casting a narrow net, and they view their user base as sort of worth X number of dollars in the future, saying, well, when we hit 1 million users, that'll be where we can sell $30 million worth of worth of ads in, and I'm saying, well, that's $30 a user, and Google's users are all worth $6, and we all use Gmail for free. And so it's like, why are you 5 times more important than Google? And sort of having sort of a rational back end. And so nailing the revenue model.
And what do they say?
Well, then it's usually you're like, I've yet to hear that was one company instance, but
Yeah.
really, I mean, but
No, I get that. A media company will say, well, we're charging $80 CPMs. And it's like, yeah, is anybody actually paying those $80 CPMs though?
right. And so for companies really to be able to, I'm not going to push back on how your revenue model is working when you have 100 users and you're trying to grow from 100 to 1,000 because you're offering it for free and you don't want to put it, you just want to build that user base. And so that's fine, but at least some kind of rational assumption as to what you think your user could be worth at the end of the day. And that'll all tie into how often they're engaging with the platform, whether it's daily, monthly, multi-daily, yearly. I mean, there's enough touch points to figure out how valuable your user is, but as long as at the end of the day, after you've scaled it, you have a reasonable viewpoint of what that looks like, I think that's enough to convince an investor that you're building something that will be monetizable or it won't be.
Yeah, I was just going to say, I mean, I think we all know media companies that were worth a lot because they had a huge audience, and now they don't, or now they don't exist anymore. So when we look at companies, we're skeptical of what, as well when you show us the math that shows us what your company's worth because it's based off of eyeballs. And if you have some other way to make revenue besides that, like you mentioned e-commerce or SaaS or something like that, then that's obviously a benefit.
Yeah. What's more important, audience or revenue model? If I come to you and I say, hey, I've got a audience that's tens of millions of people, but I have no clue how I'm going to make money off of it, what do you say?
Well, within media, I would say audience. I mean, obviously, if you've got a revenue model that prints money on 4 different sides of the market and people are clamoring to pay it and they don't blink at the price, sort of like a Netflix where I feel like probably half the subscribers of Netflix don't even log in once a month, but they're still happy to pay that $9 or whatever it is right now to get the content. Great, you've got an awesome revenue model and an excellent value proposition, but for the majority of media startups that are still trying to nail, if you don't have a service you're providing, if you're just providing content, then in my view, it's the audience. But understanding the value behind that audience.
Yeah, I think for everyone here that's here because they want to figure out how to raise money and what the best way is to kind of present themselves. The audience is obviously first and foremost, but at least have thought about the revenue model and be able to speak eloquently about, here are 3 different ways we might be able to make money, and here's how that will, back of the envelope calculation get us to the revenue that you guys want.
Yeah, there's many businesses on the web that have sort of obvious business models, right? If you're starting a gaming company or mobile gaming company today, you're probably going to build an audience and then have microtransactions. If you're building a content business, you're probably going to sell advertising, in which case the advertisers are going to look at the size and value and engagement level of the audience. I would say, though, that depending on the stage, if it's an early stage company, I want to see the ability to scale audience quickly. If it's a later stage company, I'm actually very interested in their ability to build a sales force and execute. And I think there's a lot of great media businesses, content that's wonderful, that have engaged audiences, where the teams haven't figured out how to execute and grow a sales force and articulate a value proposition to advertisers. And frankly, that's just like black magic. And if you can find a team that knows how to sell to advertisers, you back them. And you hope that the teams that you're backing beforehand can figure that out.
I want to ask, turn to the audience and take questions if there are any in a minute, but I also want to ask you guys a couple of questions just about your own kind of careers. In terms of your batting average, so to speak, what's a successful batting average for you in terms of the number of companies that you invest in and how many you have a successful exit from, essentially? I mean, if you're batting 200, are you an all-star? 300? What?
It's a function of the stage you invest at. I mean, if you're a late stage investor backing Slack in the most recent round, you better have a batting average of about 85 to 1,000%, just because your upside is limited. You're only making in those investments at the late stage you're making 2-3x your money in the really good cases. And so you can't afford to have situations where you're losing money, or at least you are just returning capital, but you've been locked into an illiquid asset for 2 to 3 years. As you get earlier, that risk tolerance shifts, where at the early stage, the Series A investor, you have your portfolio that 3 companies go to 0, 3 just return their money barely, 3 maybe double, and then 1 returns 15 times what you invested, and it's the dragon that made your portfolio what it is. And so our fund, we're in between those 2 rounds. We're Series B, so we try to scale it as sort of a 0.5 to 5x kind of range. It all depends on your stage to then translate to what your batting average is.
Got it. So Eric, that means for
Yeah,
you.
so when we look at companies, we every company we look at, we say, what does this have to sell at for us to return the entire fund? And then if we do that with that particular company, then everything else that we return on top of that is money that we've made.
Mm-hmm.
So that, and then we invest $500,000 checks to return $30 million to us.
I'm not a math major, but that sounds like a good investment right there.
Well, hasn't happened yet. We also have all of our companies. None of our companies have failed yet either. So we're doing all right.
Yet.
Yeah. Anything to add?
No, I mean, we're probably in that sort of 3-3-3-1 phase as early stage investors. And I think that, I mean, if you look at the overall venture market, it's the very, very few winners that drive the bulk of the returns to the industry as a whole. And so if you start, if your portfolio is too narrow or you miss some of those massive companies, you actually start to take yourself out of the black and into the red as a fund, unless you're very late stage and are just investing it in much less risky bets.
Questions from the audience? Over here, sir.
So basically what I hear you saying is one can look at the fundamentals of a company, but from a portfolio perspective, you're trying to broaden your risk for your early stage investment.
Well, yes. I mean, we wouldn't invest into companies that were competitive, and so that comes into play when we look at a company in a particular vertical. We're not gonna. We would always ask that company, what do you think about this? Does this look competitive? And we wouldn't invest in something that's competitive. Is that what you're asking?
Yeah, no, what I'm asking is that though the people would like to ask the startups that, what is your criteria of investing in a startup? But from your perspective, you're actually just trying to broaden to mitigate your risk. You are ready to spread yourself on a lot of startups, given that some level of fundamentals are there.
Well, within our portfolio, it would be hard to pin down which one is going to be the one that's going to return the moon to you when you invest.
Right.
But the room to do it, and this is the most challenging part on the VC side, is because we'll see companies that are great companies, especially Series B, where a Series A fund that we know and love and respect, that they'll bring us a company that we will feel is a good company, but the upside potential isn't one that would return our fund or have such a excised return from where we're coming in.
Right.
And we can't return capital to investors with just doubles and triples.
Right.
So we need those big home runs to really bring the overall returns up.
So may I say that approximately the way Ogilvy said, half of the advertising works, I don't know which one. Does that hold true?
Well, I mean, at the time of investment, every deal a VC's ever done, the moment after they invest, like, oh, I'm so excited about this company and then the first quarter happens, and you're like, oh my God, this company is going, this is terrible. I can't believe I put money to work here. I can't believe I didn't realize this. And so time always is sort of the check on that. So it's more just recognizing at the outset that it has the potential to be something really, really great, right, to make it worth your bet on the outset.
At the buzzer, I think you had your hand up. Let's do it.
Yeah, just kind of off the topic, but for people who are interviewing at startups, a lot of times they'll throw out, we raised 30 million in funding or 3 million last month. What questions should we ask that aren't too invasive that would actually impress the potential startup employer?
When they tell you, how many shares you're going to get, dig deeper and figure out what that actually equates to as far as monetary value and percentage of the company. And if they aren't willing to divulge that to you, then they're probably hiding something. And if they are, then they'll probably be impressed that you actually took the time to figure that out.
I might not do that, just depending on the size and because
I guess it depends
yeah.
on the size. If it's super late company, then
I mean, obviously, when the company raised money last is a good indicator of how long you'll have a job there. If they just raised $10 million a week ago, and then it's great. Then the lights will be on for the next year or so. So not much to worry about. But if they haven't raised money in a really long time, then it's like, okay, like how much risk am I taking by joining this company right now? I would say really trying to figure out, like, with a lot of startups, there isn't really a sort of the head of HR is someone they hire last. And while they're writing a spec and putting a job post online, they don't really, good candidates jump out to them and say, no, well, this is the 9 things in your spec that aren't written there, but I think would be really valuable to this company. And sort of going out beyond what the company thinks it wants just because it read somewhere that this is what a VP of marketing looks like generically. But if you're looking at your individual startup and saying, I'm noticing that they're not marketing to these channels or they haven't built these relationships to Salesforce and ExactTarget, that I can bring that to the table and that's outside of the job description, then that's going to be a slam dunk interview process, at least in my view.
I'll give a piece of recommendation, which isn't exactly an answer, but is something that I run into with candidates that actually I think do very, very well working with startups, is actually talk to their investors. So, and it depends on the role and it depends on your own Rolodex and your connection to the venture community. But I think that if I'm a CEO and I know that you took the time to actually kind of ask around, you can get a lot of very unbiased feedback, maybe not from the investors in the company, but maybe from investors that know the company or saw the company present and have a good litmus test. And some of it can sort of allay the concerns you might have about, is this company the leader in their space? Do they have runway? Are they literally about to go out of business because everyone's passing on them? And at the same time, I think that, typical CEOs like to have employees that understand the startup ecosystem. They understand that it's not just about the company, but about, the sort of people supplying the money and the customers below. And so I find that people are very impressed if you've sort of done your homework and your due diligence before you go in.
Great. Yeah, thanks, guys. I think we need to wrap up. Good question, good tips. Thanks.